Welcome to today's Explainer. We are jumping right into a totally fascinating corporate case study today. We're looking at Turning Point Brands and their incredibly aggressive transition strategy in the first quarter of 2026. This isn't just your standard run-of-the-mill earnings review. It is a front-row seat to a company attempting to fundamentally rewire its DNA in real time. We're going to break down their whole pivot playbook, looking at the massive growth, the rising costs, and the regulatory risks they're balancing. So let's get into it. Okay, for a little context, Turning Point Brands is historically a legacy tobacco and smoking accessories company. You might actually know them for iconic heritage brands like Zig-Zag rolling papers or Stoker's chewing tobacco. But as we all know, the landscape of nicotine consumption is changing rapidly. So today's core narrative is about a traditional company executing a really rapid, high-stakes pivot toward a smoke-free future. They are zeroing in on modern oral nicotine pouches, specifically their FRE and ILP brands. It's a classic turnaround and evolution story, and honestly, the numbers we are about to see are pretty eye-opening. I mean, just look at this staggering number, 133%. That is the year-over-year surge in Turning Point Brands' modern oral net sales for the first quarter of 2026. They hit $52 million. That kind of triple-digit growth is exactly what management wants to see when they're attempting a corporate pivot. It tells us that consumer demand for these smoke-free, white pouch products is absolutely exploding, and Turning Point is aggressively capturing that market share. But as you'll see in a minute, growth like this definitely doesn't come for free. Here is our roadmap for the Explainer today. First up, the Q1 2026 earnings snapshot, followed by that explosive modern oral growth. Then we'll look at the Zig-Zag legacy decline, the costs of pivoting, FDA delays and risks, and finally, wrap up with their raised 2026 outlook. All right, kicking things off with Section 1, the Q1 2026 earnings snapshot. When you look at the top line here, things look fantastic. Total consolidated net sales rose a very healthy 16.8% to $124.3 million. Gross profit also climbed 14.6%. But look at that bottom line. Net income actually declined by 19%, down to $11.7 million. Adjusted EBITDA, which is basically their core operational profitability, also fell slightly. So you might be wondering, how does a company grow sales by nearly 17% but see its profits shrink? Well, that is the ultimate paradox of a rapid corporate pivot, and we're going to explore exactly why that happened. Moving right along to Section 2, explosive modern oral growth. You have to see this shift in the business mix. Just 1 year ago in Q1 2025, modern oral products made up 21% of the company's total net sales. Fast forward to Q1 2026, and that slice of the pie has literally doubled to 42%. Think about that. In a single year, these oral pouches went from being a promising side hustle to making up nearly half of the entire company's revenue. Gross revenue for modern oral actually grew by an incredible 167% year over year. That was driven by rapid expansion in both direct-to-consumer and retail channels. Guys, this is exactly what a successful pivot looks like on the top line. Now for Section 3, the Zig-Zag legacy decline. To really build a complete picture, we've got to look at the divergence here. On the left side of this chart, you've got the Stoker segment, which houses those modern oral products, just skyrocketing with a 48.1% increase in net sales. But over on the right side, we see the legacy Zig-Zag segment, which sells traditional rolling papers and wraps. Sales there declined by a concerning 22.4% year over year to $36.7 million, driven mostly by lower U.S. shipments. Now, management does note that these heritage brands still provide strong cash flow to help fund their modern initiatives, but this stark divergence, it shows exactly why Turning Point is working so incredibly hard to diversify away from combustible smoking accessories. Which brings us to Section 4, the cost of pivoting. Remember that shrinking profit we talked about earlier? Well, here is your culprit. A massive 53.2% spike in selling, general, and administrative expenses, or SG&A. Spending jumped to $55.8 million for the quarter. The reality is, when you're trying to grab market share in a hyper-competitive, newly emerging category like nicotine pouches, you can't just put the product on a shelf and cross your fingers. You have to spend heavily to get noticed. This aggressive spending directly drove down net income and compressed their earnings in the near term. In fact, it led to a negative $27.4 million in free cash flow for the quarter, meaning more cash went out the door than came in. So where exactly is all that money going? Well, Turning Point is investing heavily in expanding its sales force, scaling up manufacturing, and pushing massive marketing investments. A really prime example of this is their recently announced super high-profile partnership with TKO and the UFC for their white pouch products. They are literally paying to put their brand in the center of the octagon to drive consumer awareness. Add in higher outbound freight costs, and you can easily see why operating expenses just ballooned. But management believes this is a necessary early-stage land grab. They're totally willing to sacrifice short-term profits right now to build a long-term fortress in the modern oral market. Let's pivot to Section 5, FDA delays and risks. You absolutely cannot talk about nicotine products without talking about the FDA. Market analysts are pointing out a massive risk here. Reports suggest the FDA might delay authorizations of certain oral nicotine products as they weigh the risks to new users and children. The Premarket Tobacco Product Application, or PMTA process, is incredibly resource-intensive. Turning Point currently has applications pending, and slower regulatory approvals could directly delay their new product launches. Honestly, this is the biggest wildcard in their entire playbook. If regulators decide to crack down on flavors or change how they treat these modern pouches, it could dramatically reshape Turning Point's growth timeline. It's a major risk factor that anyone following this space needs to watch closely. All right, our final section, number 6, the Raise 2026 Outlook. Despite those FDA risks, Turning Point's executive team is clearly confident in what they're seeing on the ground. They actually materially raised their full year 2026 guidance. They are now projecting modern oral gross sales to land somewhere between $280 million and $300 million. That is a significant bump up from their previous forecast of $220 to $240 million. Net sales for the segment were also revised upward. What does this tell us? It tells us that the early returns on those massive marketing investments, like the big UFC deal, are giving them the absolute conviction to double down. Furthermore, the company introduced full-year adjusted EBITDA guidance, projecting between $70 million and $90 million. The big takeaway here is that management is signaling, yes, we are spending heavily right now, but we still expect to generate substantial underlying profitability over the course of the full year. They actually expect to be cash flow break-even for the remainder of the year, which is heavily supported by a very healthy balance sheet featuring over $192 million in cash. And guess what? The broader market completely loved this narrative. Following the release of these Q1 results and that raised guidance, Turning Point Grand's stock price surged over 11% in a single day. As highlighted by financial outlets like The Motley Fool, investors clearly looked past the short-term profit dip and the legacy declines. Instead, they chose to reward that massive double-digit top-line growth and the company's aggressive forward-looking strategy in the smokeless category. Which leaves us with the ultimate question for our explainer today. We've seen the playbook, we've seen the jaw-dropping 133% growth, the heavy marketing costs, and those looming regulatory shadows. So the question is, can the massive growth in modern nicotine pouches actually outpace the unpredictable FDA risks and the structural decline of their legacy combustible businesses? Turning Point Brands has firmly placed its chips on the table for a smoke-free future. It is going to be a totally fascinating strategy to watch unfold over the rest of 2026. Thank you so much for joining me for this explainer, and as always, keep learning.